So this is going to be another quick video. I'm doing these videos as a way to help people better understand some of the things that we do in the firm. And I try to do one weekly or bi-weekly. But anyway, this particular video is going to be about quarterly estimated tax payments or prepaying your taxes to the IRS. So the estimated taxes by regulation, we're required to prepay our taxes. Well, what's nice about the taxes is we really don't know how much we're going to owe. And so the rule is that you're required to prepay up to 90% of what you currently owe, or 100% of what you owed last year. And then it's calculated on the actual tax return when we file. Well, what does that mean? That means, let's say in 2022, you owed $10,000 in tax. You have no idea what you're going to owe for 2023 taxes. So typically what we do is we estimate we pay that amount of $10,000 over the year. Basically, you make 4 quarterly payments to the IRS of $2,500 each quarter, and then you would have paid 100% of your prior year's taxes to prevent any failure to pay penalties. Because we don't know what you're going to owe for 2023 taxes. The year could be good, the year could be bad. We don't know. So in order to prevent penalties, you prepay your taxes at 100% of the prior year. So if you paid $10,000 in 2022, you would then pay $2,500 every quarter to prepay your 2023 taxes during 2023. The problem with that is you're giving the government an interest-free loan. Let's say the year is down, and so you wouldn't owe that tax, and so you get a nice big refund because you prepaid your taxes more than what you needed to, so you get a big refund. The offset to that, so you're giving the government an interest-free loan. They don't pay you interest if you get that money back because you overpaid. The offset to that is if you underpay or you don't pay, then you get penalized with what's called the failure to pay penalty. Now, the government likes to use those scary words to, basically make us come into compliance based on fear mongering, right? The penalty is the same thing as interest. Basically, you could take that $10,000 and do anything else with it, not pay the government, and then the government's going to charge you that failure to pay penalty. Right now, the failure to pay penalty is 6%. So that means you're getting charged a 6% interest rate on that $10,000 for not paying it. I think that's what, $60. Let me just do my math real fast. Or $600. Okay, $600. I 10 off. So you could take $10,000, not give it to the government, and you would be charged $600 in interest. They call it a failure to pay penalty to scare you. So that's the offset, is you either give an interest, you prepay your taxes to save that 6%, or you keep the money and you get charged 6%. So at this point, it's really just time value of money. So whenever I prepare a tax return, if there are going to be required quarterly estimated tax payments, then I will provide you with those payment vouchers as part of the tax return process. And then you can decide whether you want to make the payments or not. But really, at this point, it's just time value of money. And the basic rule of time value money is if the cash in your pocket today is worth more than it will be in the future. And that's where we get interest from, right? The idea that if I give you money, that means it's not in my pocket anymore. So I need to charge you interest because when I get that money back, it's going to be worth less than when I gave it to you because of inflation or whatever else, right? Like money in my pocket today is worth more. So if I give that money to the government, then I'm saving that 6% interest rate. If I keep it, I'm going to get charged 6%. Well, there is no cheaper source of funds anywhere in this world than the government. Money has a cost regardless of where you get it from. So unless it's like a gift, right? But we're not talking about gifts. Gifts don't count. You get money from earning it. So you put in your time to earn that money. So there's a cost of time. You borrow it from somewhere, whether that's a credit card, a long-term debt, short-term debt, something, you're borrowing it from somewhere. Well, right now, a credit card, depending on which company you go to, you're looking at 15 to 20%. Significantly higher than the government. Meaning, in other words, you never use a credit card to pay your taxes, ever. You are better off to never pay your taxes if your only source of funds is a credit card. The other way you get money is long-term debt. And long-term debt, like a 30-year mortgage, is probably going for about 8% right now. And the reason why everything else is more expensive than the government is because by law, the government's rate is prime plus 2 percentage points. And prime is really the best idea of prime is what do the banks borrow money from the government at? So the banks right now are able to get money from the Fed at 4%. So prime is 4%. I mean, this isn't like the actual real terms, but it's close enough. This is the best way to really understand it. So banks are getting money from the government at 4%, depending on their, banks are rated too. They have credit scores as well. But so they borrow at 4%. So nowhere in this world are you going to get 4% on anything. You're not going to get prime anywhere. You're always going to pay more than prime. And the government charges prime plus 2 percentage points. The banks are always going to charge a lot more than that. In fact, they're going to charge you, or if you put money into a savings account, they're going to pay you less than prime because now you're an expense too. And so they want to make sure that they're always able to get more than prime anywhere. And if they're borrowing money from you, they're going to give you less than prime. Well, what a lot of people do when they understand interest rates and time value of money, like day traders or stock traders, what they might do is that they'll say, oh, I have this investment that's going to earn me 15%. And if I go to the bank, I can borrow a short-term loan for 3 months at 10%. I think I used the numbers right. So they're going to get 15% return on investment, or they think they're going to get 15% return on investment. So they borrow at 10%. And the goal, their idea is they're going to carry that risk to, in 3 months, they're going to sell their investments, take their 15% capital gains, use 10% of that to then pay off the interest on that short-term loan. So they net a 5% capital gain. We can do the exact same thing with the government. The difference is we don't have to get approval. We just say, hey, I'm not going to prepay my taxes. So if I owe $10,000 in quarterly estimated tax payments, I'm going to say, no, I'm going to take that $10,000. I'm going to shove it into an investment account where I'm going to get some sort of return. I personally use mutual funds because they're safe. Now they do get usually less return, and I use high dividend yield mutual funds. That way I can guaranteed to get some sort of return on them in form of cash. I get dividends. And hopefully, this is the risk, hopefully my dividends are going to be more than the interest that I owe to the federal government. So if I owe $10,000 in quarterly estimated tax payments, I don't make those. I put it into an E-Trade account. My goal is that I'm going to make $800 in dividends and capital gains. And then suddenly my taxes are now making me money. There is some risk to that, right? But that's the idea of quarterly estimated tax payments. You are required to prepay your taxes regardless of how you're earning your money. Employees pay withholding, right? So they have income tax withholding on their W-2s. As a business, you're required to make quarterly estimated tax payments because there is no withholding, but it's all the same rules. somebody making W-2 wages, if they don't have enough withholding, they're going to get charged that same failure to pay penalty. So I had a client that was making north of $1 million a year in W-2 wages as an attorney. So I advised him, hey, you're making $1 million in wages. That means your income tax withholding on your W-2 is probably like $300,000-$400,000. If you want to take the time to play the stock market, you could turn that $400,000 into $600,000 before the end of the year. And now your taxes have made you a ton of extra money, and your penalty is going to be something like $50,000. So you've made $150,000 in capital gains and dividends on something that only cost you, so that would be your gain. And you made 200,000, it cost you 50 grand. So those are the concepts that you can use. If you want to just pay your quarterly estimated tax payments, that's fine. There's a website. You just jump on the irs.gov website /payments, and you can make your quarterly estimated tax payments, or you can mail in a check with the payment voucher, and all it's going to do is save you that failure to file penalty. But no guarantee that that's even going to, you're probably going to get a refund. That might not even cover all of your taxes, depending on how the year goes. It's going to prevent a small penalty, but it's not going to benefit you. In my opinion, it really doesn't benefit you any, because you can take that money and do like even just spending time with my family. Instead of paying my taxes, I'm going to Disneyland, right, or whatever. Get to spend time with my kids. That's priceless. That to me is worth more than paying the government, right? And it's definitely worth more than taking a credit card to pay to go to Disneyland, because that's going to be 20%, 15 or 20%. So it's definitely cheaper to borrow from the government than to borrow from the bank. And you don't have to get approval for it. You just don't make the payment. There's no approval required. There's no there's no loan application, nothing. You just don't pay them, and you'll get charged an interest rate. And then we can take the same concept when we actually know what your taxes are. So we hit 2023, we calculate your taxes. We say, hey, you owe $15,000 in taxes because you didn't make your $10,000 quarterly estimated tax payments. Great, you owe $15,000. The interest rate's still 6%. So yeah, the only reason why I ever pay my taxes is because eventually they can throw me in jail for failure to pay my taxes, right? But if I could say I have $15,000 in cash that I owe to the government. Instead of paying the government, I'm going to let that accrue 6% interest forever, because I can forever take that $15,000 and put it in the stock market. It's risky, right? I mean, there's some risk there, but in theory, over time, the stock market has gotten 10 to 15% return annually since the beginning of record keeping. That includes the Great Depression, that includes all the recessions, everything, like 10 to 15%, depending on what you invest in, small cap, large cap, whatever. That's what the market has gotten over time. And so by me saying, government, I'm not going to pay you, I'm taking my $15,000, I'm shoving it into an investment account, and I'm going to wait for you to come after me. And then it's going to sit there growing at 10 to 15%, and you're only charging me 6%. And 10 to 15% is actually doesn't take into account inflation or interest rates or anything. Like that's what the stock market has historically grown at over time. So if interest rates go down, the amount the government's charging me is going down. So I might be only getting charged 2% at one point. I mean, for a long time, we were only getting charged 3% by the government because interest rates were actually 0 or 1%, back in 5 years ago. And so I could be taking that $15,000, putting it in the stock market, getting 10% on it, while the government's only charging me 4, 5, 6%. Now, eventually somebody's going to come knocking on my door and say, hey, we're the government. You owe us $15,000 plus interest. Why haven't you paid us? And then I'm going to hit sell, take my capital gains and say, here you go, government, here's your money. And wait for them to come force collections. Because now I've made lots of money on my taxes. I am making money on my taxes that way instead of the government making money on the taxes, because we all know the government's just going to spend it, and they're going to spend it horribly. But I can use that money to make me money. So that's kind of my stance on things when it comes to quarterly estimated tax payments and actually paying my taxes. And that's why I tell everyone, my return, I don't file my return. I don't pay quarterly estimated tax payments. I don't prepay my taxes. I put my money in the stock market, into mutual funds. Then my return is the very last return that I file without being late. You know, every year I have a few people that give me their stuff late, so I file before them, but I file my return usually October 15th at about 11 o'clock at night. And it's the last return that I file. Then I wait until I get my first letter from the IRS saying that I owe money before I even pay them. Usually that means I don't pay the government until December. I pay my state taxes right away. The states are very aggressive. Don't piss off the states. I tell everyone, pay your state taxes right away. We don't want to get the states mad. It's very easy for the states to put a lien on our property. The federal government moves very, very slow, and it's usually pretty unlikely that they're going to put a lien on your property at any point. They have different thresholds that they look at and different things, and literally one of their thresholds before they even want to touch you is $10,000. You might end up in collections before that, but that usually they don't even want to touch you if you're less than $10,000. So what I usually do is I wait until December. When I get that first letter, it takes them about 2.5 months to get me that first letter saying that I owe my taxes. Then I pay those federal taxes. That's how I do it, because that way I'm able to keep my cash in my pocket, earning money for me before I give it to the government. So that's my stance on quarterly estimated tax payments. That's how I treat it for myself. And that's how I treat myself for actually paying my taxes when they are due. The last people I want to pay is the government. Okay, hopefully this helps clear up any questions that people have on my stances when it comes to quarterly estimated tax payments or even paying our taxes, period. Like I said, it's really about you and how you want to manage your own risk. But that's how I do it for myself. So anyway, thank you, and I hope you all have a wonderful day.